we there yet? It's amazing how the message in the media has changed over the past couple of weeks. Not that long ago, they were talking about property prices falling significantly further. Now the media is asking, have we reached the bottom? So how do you pick the turning point in the property market? That's what I'm going to discuss today with Dr. Andrew Wilson, Australia's leading housing economist and chief economist for myhousingmarket.com.au. Welcome, Andrew.
Thank you, Michael. Yes, it's been an interesting period in the housing market in terms of a U-turn.
Hasn't it? But as they say, no one's going to ring a bell when we reach the bottom. Yeah. So rather than trying to be smart and rather than trying to pick the bottom, in my mind, it seems now is a good time to try and buy countercyclically, because you probably are going to then look smart in 10 years' time. But let's start off by looking at some of the indicators, what we're going to watch out for that are going to give us a signal that the market could be turning. And first of all, Andrew, we've got to remember that the property market doesn't work in isolation. It's part of the general economy. So what economic fundamentals are you going to be looking at to tell us that it's a good time to get into property?
You're right, Michael. And look, the bottom of any cycle is always visible after the event. I guess that's the real skill set in terms of economic cycles, business cycles, house price cycles, is being able to pick the change in the cycle itself. Always become, as I said before, apparent after the event, but it's certainly difficult in terms of a measurement process to pick it up as it's actually happening in real time. This is fertile ground for predictions and fuels media, I guess, speculation, and we're seeing plenty of that at the moment. But I've always said that the value or the cost of money is a key indicator of market dynamics. The underlying aspiration for housing ownership and housing investment in Australia is very, very strong. That means that it's the cost of money that is the key driver. And we look at the historical series of house prices and movements in interest rates, we can see a very strong correlation. Even with local market dynamics, we still see that correlation. Local markets perform at different rates, and that's because they have different supply and demand drivers. But the underlying noise, the underlying growth trend in all housing markets is typically driven by changes in interest rates. So interest rates, number one.
Well, also the availability of finance and credit being a bit loose is going to help, Andrew.
Well, that's right, Mike. So it's not just official interest rates, it's also lending conditions as set by the regulator. And of course, we've seen some easing in the restrictions of finance and the finance environment for risk modelling from APRA recently. And all these things, of course, work into loosening the lending strings and creating demand for property, because property becomes more affordable with lower interest rates and easier lending conditions.
Well, the other thing we, of course, look for then is the metric of housing credit, because people get their loan approved, or many people do, prior to buying their properties or starting looking. So that's a leading indicator. It often shows up before the market turns, Andrew.
The one thing we've got to remember with a lot of this measurement process in terms of talking about where the market is in real time is that there are lags in the measurement itself. Typically, we have around about a 6-week lag from the end of the month from the ABS for lending finance to when it's actually released. So we are always looking backwards, even with those leading indicators in terms of where the market is right now. But it does validate that how important interest rates are in determining the volume of lending that we see. So it really is about looking at interest rates, where they're likely to go in terms of where the market is now.
Another thing to look at is market sentiment. Since the election, consumer sentiment has increased. Interestingly, a while ago, the ANZ Bank brought out a particular metric it looks at called House Search Index. It actually sees how many people are looking at Google searches on houses and property. So consumer sentiment's important. Also, how consumers feel about their jobs and certainty of their jobs. All that factors in, doesn't it?
Well, look, hard data in terms of measuring searches, as you said, Michael, certainly has some validity. I'm not a big fan of sentiment indexes or indices. I think that a lot of people answer business sentiment or business sentiment responses and consumer sentiment responses tend to be answered by what the actual respondee thinks that everybody else is saying.
Well, you're right. The consumer sentiment is not a good indication because we know the crowd is usually wrong. They're usually late. By the time the crowd finds out that the market has turned, it's because they've read in the papers that auction clearance rates are high. They've read on the internet that prices are going up. And those who got into the market 3-6 months earlier are the ones who've already turned the market. But it's one of the things we've noticed at Metropole that the more people who are sitting on the sidelines, especially during the election period, wondering what's going to happen, are now taking the plunge to buy homes and also getting more serious about property investment because some of the fear has gone. So we've talked about the things that we're looking at that are going to point towards a change in the property cycle: affordability, market sentiment. We also want to make sure our economy is pointing in the right direction, because all of these aren't going to work if we're not getting jobs growth, we're not getting GDP growth, and if inflation stalls, Andrew.
Well, that's right, Michael. And lower interest rates really aren't a good news story in terms of the macro economy. The Reserve Bank has had to finally concede that the economy hasn't performed as expected, particularly in relation to incomes growth and inflation. We've had a very strong jobs market. A lot of that has been, as we've discussed, generated by record levels of migration. It has assisted us in getting back in the black in terms of our budget surplus. We will have tax cuts, which will assist in getting more money in people's pockets. But we are now starting to see the unemployment rate rise. This will only continue upwards, I believe, given the shakeout in particularly the development industry, the apartment development industry and the property industry, which will cause a loss of jobs because we don't have a significant amount of work as we've had coming in through the pipeline now for apartment approval, which has been a significant driver of the Australian economy in terms of jobs. And I think this is why the Reserve Bank is really perhaps kicking and screaming, being dragged to lower interest rates to try to re-stimulate the economy to offset what will be weaker unemployment outcomes. But let's be quite clear that the economy is still quite strong, Michael. 5% unemployment is, if we get to 6, it starts to become problematic. But we're still going to be in the 5% range and we're still creating jobs. It's just not at that level where we can increase incomes. It hasn't happened, that increase in incomes through low unemployment.
Okay, the other thing we always look at is supply and demand. So on the demand side, we look at household formation and population growth, but more specifically how many new households. And on the other side of it, you're looking at building approvals, which seem to have dropped off, and see what's still in the pipeline.
That's right, Michael. And of course, it is the old supply and demand equation. And really over the medium to longer term, we're always undersupplied in this country for property. So that means the upward, I guess, process of rents and prices is always there as an underlying force. We're going to see that revealed over the next 2 years, where there's been a remarkable collapse in the approvals, particularly for apartments. The lags with production mean that supply won't come into the marketplace for a couple of years. We still have strong demand, strong migration levels. They've come down a little bit, but they're still quite high. First home buyers are active in the marketplace, and we will see changeover buyers now becoming more active with lower interest rates and, as you suggested, less fear in the marketplace. So we will move into that undersupply environment that we typically have over the medium to longer term. And of course, that means higher prices and higher rents. So that is something we should look at, Michael, when we are determining particularly where the medium and long term is in terms of the housing cycle.
It's that long lag phase in the property development cycle that creates this. So developers at the moment are having difficulty getting finance. They're still getting rid of old stock. So they're not buying new sites. And when they do in a couple of years' time, then they're going to have to get them approved. They're going to have to amalgamate the sites, get town and planning approval, sell them on. And it'll be quite a few years before the next huge building boom. So each boom leads to a bust, just like each downturn now leads to the next upturn, Andrew. Well, let's have a look at some of the metrics that you and I look at independently to see what's happening. One of them was housing credit growth that we've already discussed. The other one that I find interesting is days on market. In other words, how long it takes an average property to sell. Now, we don't look at the whole of Australia. You've really got to look at markets, and then you've got to look at whether it's houses or apartments. But clearly this year it's taking probably twice as long to sell most properties than it did a year or two ago. And that's an indication of, I guess, partly supply and demand, and also it shows that in many ways we're in a buyer's market.
Well, a couple of things about days on market. Firstly, of course, they validate what everything else says. I mean, it's properties take longer to sell because prices are falling. They sell quicker when prices are rising. So it just validates the price data, which just reflects the lending volumes data, which just reflects the inflation data, with the official interest rate data.
It's a good marker of what's going on. It's a combination of a whole lot of things, like vendor discounting. In other words, today, people are going to have discount their properties more than during the boom times, but that will in turn change as the market moves on.
So again, not only does it validate what's happening in the sales in other metrics, days on market, but also it has the same problems with being telling us what's happened months before.
Well, let's talk about then what I know you measure, and that's asking prices, which is the Wilson Index, which actually tells us not the sale price that's occurred 3 months, 90 days ago, but what's happening at the moment. Why do you think that's more important?
Well, it's a measure of market sentiment in real time, Michael. I mean, when you list your property, you ask an agent for their expert advice on what its value is. Listings data takes advantage of real-time sentiment, takes advantage of an expert's opinion, and of course it's coming through, we can record that in real time. And when we look at the change in prices that are listed and we look at the changes in prices that are sold, we see there's a remarkable correlation between the two, but it gives us that real-time look into the market. But the other thing, Michael, in terms of listings is the actual listings volumes, and it's not the total listing volumes, because that can be inflated, as you suggested before, because of higher days on market levels. But if we look at the number of new listings coming through, which can be measured, that tells us the sentiment for sellers. And of course, this year we've seen a dramatic collapse in properties listed for sale. Again, we can see that in real time because these are detailed on the listings portals.
So just to make it clear for those who don't understand, most reports are selling prices, and that's what the hedonic price indexes are, and the ABS comes much later. What you're measuring is something that happens before the sale, the asking price when listed. But what I have seen your data, and you've shown me, is when you look back 6 months, 9 months, a year later, it actually very much indicates what eventually gets reported by the others with quite a level of accuracy, but 3 months or so before. Another thing I look for is the turnover of properties, how many have sold. So you will first see, as the market picks up, a bigger turnover. That doesn't necessarily mean prices are going to go up straight away. In other words, the stock that's been sitting there eventually sells, then more vendors, sellers decide, hey, I can see things are starting to move in my neighbourhood. They put their houses on the market. So there isn't suddenly an increase in prices when buyers hop back in the market.
Well, that's right, Michael. As with all these measurements we're discussing, forward and lagging indicators, there's always a lag.
And another metric that investors should keep an eye on, of course, is vacancy rates, because you want to make sure that there isn't too much of an oversupply, Andrew.
Absolutely, Michael, and that's a very positive measure for investors. We can see that correlation quite clearly between higher vacancy rates and lower rents, and between lower vacancy rates and higher rents. Bit of a rule of thumb is that there's downward pressure on rents when vacancy rates are below 2%. 2 to 5%, 2 to 3% usually means a steady rental environment. Once you start getting to 3% and over 3%, you do get downward pressure on rents. So those higher vacancy rates mean lower rents.
So as I said right at the beginning, no one's going to ring a bell. No one's going to know until it's well over. So don't be too smart and try and pick the bottom of the market. If you're a home buyer, it's a long-term decision. So don't let the market make a decision on when you buy or sell your home. If you're an investor, in my mind, it's a good time to look countercyclically, knowing that there could still be a small drop of a couple of percent in Sydney and Melbourne, or you can still ride the wave in those states and those areas where there is a rise in prices, a bit like Canberra and maybe in Brisbane, where the market's still picking up a bit. And when you read the various reports, we've just gone through a whole lot of metrics that you can look at, fundamentals you've got to look at, because they all interact, Andrew. But I think as we keep talking on these weekly Property Insider shows, we're going to find there's going to be a much improved market in the second half of 2019 than there was in the first half. So good times ahead. Thanks for joining me for our weekly Property Insiders show, Andrew. I know we've got some interesting shows lined up. Catch up with you next week.
Thank you, Michael. All good.